Right, good evening, everybody. I'm just waiting a couple more minutes, a few more seconds for the late joiners. Please be patient. We shall start. All right, it's 2 minutes past. I think we can get going. Thank you all for taking the time to hear this webinar. I'm not sure if it's the slither of optimism in the title of the webinar, or if it's the state of markets and world affairs, but we've had a lot of people register for this webinar, far more than we normally have for our quarterly webinars in English. And so I'm really happy about that. I'm honored and humbled. We also received a lot of questions in the registration process. So I will try to address some of these questions. I can't possibly, in the 30 to 40 minutes that I want this to go on for, I can't address them all. So if I don't get to your question and you would like an answer, please just reach out to us either directly or via your relationship manager, and we'll try to set up a quick one-on-one to answer your question. But I will try to deal with the questions during the webinar and then specifically at the end. Okay, let's dive into it. Right, so just a quick snapshot of 2022. As you're no doubt aware, it's been an awful start to the year in major markets, arguably the worst start to the calendar year ever. We've had the worst start for equity since 1970 and the worst start to a calendar year for the bond market ever. So that's a very, very tough environment for your asset manager to make money or protect capital. And it's just part of investing. We do get years like this. So what's happened? We've had inflation that's higher than expected and more sticky and more complex. We've had long end rates rise much more than expected. So this hurts the bond component of the portfolio. As rates go up, prices go down. It doesn't necessarily mean you've lost money permanently, but at least on paper, the value of those bonds go down. Recession expectations are elevated. We've had the Ukraine war and other geopolitical risks. Pelosi's landed in Taiwan today. Who knows what that would cause. We've had a massive repricing of risk assets. So cryptocurrencies have lost 80, sometimes 90%. Some of the Israeli companies that were listed on the American exchanges during Corona have also taken a terrible hit. They're also down anywhere between 60 and 80%. Those type of risk assets are not in Pioneer's sort of universe, so thankfully we've avoided that. In addition to the recession, elevated chances, there's chances of stagflation. Now, stagflation is defined as low or negative growth, high inflation, and high unemployment. So we've got high employment now. We've got two out of those three. Stagflation is often thrown around as a very, very negative scenario, but for an investor's point of view, if we do have stagflation, then it just means you need to be more patient, quite simply. And then the key question, the million-dollar question is this over? Is it behind us, or is the worst behind us? And I wish I could sit here with confidence and tell you that the worst was behind us or is behind us. There's a lot of risks, or some major risks that need to work through the system, and we need, at least in my mind, 3 to 6 months to see what's going to happen. And it's not clear. It's not clear to anybody which scenario, whether it's a muted positive scenario or an extreme negative scenario, will happen. Both are possible. And I'll be talking about that a bit more in this presentation. But unfortunately, I don't believe it's entirely behind us. Okay, so whilst I was preparing for this webinar, I found this interesting quote, which I liked. I often get asked by clients or commented by clients, clients expect the market to do this. They expect the market too high, too low, go up, go down. And this quote from Compound Advisors, which is like a research firm in the States, they got a social media presence, so I follow them. Their quote goes like this: the market doesn't have to do anything, least of all what you think it should do. The market does what it wants, when it wants. It is the real-time personification of the collective human psychology, with fear and greed on full display, right? Too often we expect the market to be rational, and it isn't rational. There are many different players in the market. Not everyone even wants the market to go up. They're short positions and they want the market to go down. There's a lot of so-called dumb money. The index tracking, when they have redemptions, the index tracking instruments have to sell. Or a mutual fund that invests in, when they have a redemption, they have to sell. There's no judgment being exercised by a manager. They just have to sell. People are withdrawing fund money from the market and they have to sell. The result is that price represents where the demand and supply meet. It doesn't necessarily represent value. In a crisis, in the non-crisis, value is very subjective. But in a crisis, it's even harder to define what is value. And so we can see that the price and value diverge. Regardless how you define value, the price in the market is reflective of demand and supply. In 2022, we've had more sellers than buyers, and therefore it's pushed the price down. There are certain assets that you would hold in your portfolio, regardless, even though you're looking at an asset that it's lower in value than it was 6 months ago, it's a good asset. And as long as it's a good asset, then you shouldn't worry too much about what the market says its value is, because it's a good asset. It belongs in your portfolio. It'll recover. It's not going bankrupt. And for example, a classic example would be a traditional index tracker, S&P 500, which we hold in our global portfolios and in our Shekels portfolios. It's a good asset. And even if I was given a crystal ball and it tells me exactly what the economic scenarios are for the next 24 months, I'm still going to hold that asset. Even if I know for certain that there's going to be a recession, this is a good asset and it belongs in the portfolio. So even though the price is down, if it's a good asset, we shouldn't be too worried about it at all. Okay. And lastly, in a crisis, we as people tend to form overly negative outlooks. It happens all the time, and then the market overshoots in a particular direction, either too positive or too negative. I thought that was important to remind everyone how a little bit about the markets. Okay, let's have a look at index performance. Normally when I present index performance, I just put the year to date, but the year to date on its own is quite depressing, but it's also important to see how positive July was. And in terms of you looking for silver lining in the markets, just look at July to remind you that markets actually can go up in a difficult environment like we're in. And July was exceptionally strong. So when you get your July reports, you'll see a significant positive. It's not enough to bring us back to zero for the year, but it's very strong positive. So let's just have a look. And in addition, I've added on the right-hand side, you can see the last 36 months. So the first 4 rows of this table are the major equity markets that our typical Pioneer client is exposed to. And if you look exclusively at the 36-month column, you'll see what's the problem. It's all good. If you closed your eyes 3 years ago and somehow slept through Corona and slept through the beginning half of 2022, you'd be absolutely satisfied with your equity performance. So that's a source of comfort. Looking at the year-to-date numbers, you can see how negative they are. And then in July, we had a nice little bounce back. But it's very hard, as I said earlier, it's very hard for your asset manager to protect capital in an environment where your major indices are so far down. So that's on the equity side, and it really should give you some comfort that the numbers are quite strong on a 3-year basis. On the bond side, if you go down about 2/3 the way down, where it says global, I'm not sure if you can see my mouse, global bonds investment grade. So this is very plain vanilla index, which we use to benchmark ourselves on the bond side of the portfolio. And year to date, this index, year to date to the end of July, is minus 11.8. At the end of June, it was around about 13 point something negative. Okay. The last 36 months in this bond index is minus 9, of which minus 12 is this year alone. So that means in the 29 months ended December 2021, you made about 2 or 3% holding this very plain vanilla, very traditional bond index, which is not great. Okay, it's not a good number. It supports what we said throughout those years, that it's extremely difficult to make money with bonds. Bond yields were exceptionally low. We knew the risk in bonds, and there just wasn't reward for it. But we had to have bonds in the portfolio because bonds are part of the mandate. So you can just see how significant the bond component is in terms of the disappointment which an investor might feel. Going forward, bonds are going to give us a better yield than they did, but it was a painful transition to hold those bonds before. We reduced our interest rate risk, so the risk to rising interest rates. We'd sold our treasury bonds, and we reduced our duration significantly, but still we couldn't reduce duration all the way to 0. We had to have some duration risk there, and it was still painful. The other things that stand out here, for example, is gold. Gold year to date is a negative number in the year we've had the highest inflation ever. Over 3 years, gold has done better, but that was long before inflation ran out of control. So I'm not a huge believer in gold. I think it adds a lot of volatility and it's very difficult to predict. Israeli corporate bonds are also disappointing over a 3-year period, all reflecting this very low yielding environment that we're coming from. And one positive from this whole painful year of investments is going forward, bonds are a little bit more attractive on condition inflation comes under control. So that's the broad index picture. Oh, by the way, if anyone wants to ask a question, you can just shoot it through the Q&A and I'll try to get to it. The next slide, also by compound investors. This shows the challenge that asset allocation had during 2022. Now, our investment philosophy is heavily asset allocation based. So the first column is your S&P 500, right? And this table highlights 10 or so years where we had negative return on the S&P 500 on stocks. And the next column is your US aggregate bond index, okay? And it shows in every one of those years that you had a negative return in stocks, except for this year, you had a positive return on bonds. And now that is a traditional asset allocation phenomenon. You have a negative correlation between stocks and bonds. When stocks go down, bonds go up, and it helps to protect your capital. That's the last 100 years. In 2022, we didn't have that. We had significant losses on our bonds and meaningful losses on our equities too. And that means an asset allocation portfolio that's made up, and that's the third column, that's made up of 60% stocks, 40% bonds, which is a traditional American way of a balanced portfolio. Most of the balanced portfolio in America is 50-50 or 60-40. And you can see that a 60-40 in 2022 was minus 16%, okay? For lack of a better word, that is a reference point for you. That is a benchmark that you can use for traditional portfolio. And you could say to yourself, all right, if my portfolio to the end of June is better than minus 16, then I'm at least ahead of a benchmark. It's a big, painful number, and you can compare it to the previous years. The last time we were anywhere close to this was 2008. But 2008, we still made money on bonds. So conservative investors who were majority in bonds, they didn't feel 2008 so badly. So this has been the challenge for asset allocation. It doesn't mean asset allocation is broken, okay? From a probability point of view, any given year, it's difficult to say whether you will make money any single year. It's very difficult to say whether you'll make money on an asset allocation-based approach, but the longer you're in the market, the higher the probability of making money using asset allocation, right? If you go 10 years, then, or 15 years, your probability of making money using this type of approach is over 98%. So, and that's why we stick to this asset allocation philosophy. I firmly believe it. It's not broken. We've had a very difficult transition from low interest rates to higher interest rates with this inflation overhang. I don't think that's going to be repeated. So going forward, asset allocation should work a hell of a lot better. All right, let's just talk a little bit about the stock market. Very important for me to say, it's impossible to call the bottom, just like it's impossible to call the top. There's a lot of data coming through, a lot of economic data, macro data. It's not just the inflation number or growth number. There's a lot of data that goes through, and it's very difficult to time these in and out of the market. As I said, asset allocation works with time in the market, not timing of the market. The bottom of the stock market, what we do know, let's say there is a recession, the bottom of the stock market will be during the recession, not after. And that is why it's important to remain invested. And if it's, and then we'll be able to enjoy the rebound a little bit more. All right. If we have a severe recession, then more pain is likely. I'm sorry to say, but I believe it to be temporary. Okay. Yes, it's more. We've been through recessions before. I'll show you another slide in a minute. We've been through severe recessions. We've been through bear markets. We've been through bear markets with a recession, bear markets without a recession. All right. We will get through this. It's temporary. And if we do head to the severe recession scenario, definitely more downside is possible on equities. Take some comfort from the minuses up until June. All right. Minus June, S&P 22 or 23%. That is a big number. And that would have priced in certainly a mild recession or a slowdown or some element of controlling of inflation. That's a big number. So if we have a mild recession, then we may not see another leg down in the market. My fear is that inflation won't come down so quickly, and the Fed will have to deal with that. And I'll talk about that in a bit more detail in a second. The financial planning point of view is if you don't have the stomach for equities, then you can consider more bonds and alternatives, short bonds, not long bonds. But this must lower your long-term expected returns. And don't panic. Don't panic, because the world is not ending. I remember 2008 very, very well. And this feels different to 2008. 2008 was a systemic risk. The banks and financial services companies wouldn't deal with each other. They were all on the brink of bankruptcy. Today, that's not like that. So we don't have a systemic risk. Think of this environment more as a cyclical risk and not a systemic risk. Okay, another nice table. There's a lot of information here, but I'll just summarize it quickly. This highlights all the periods where we've had bear markets and where we've had recessions. How long was the bear market? How long was the recession in the past? And how bad was the stock market drawdown? What it shows is a few things. One, when you have the bear market and the recession at the same time, then losses on the stock market of greater than 22%, more like 40%, peak to trough, are quite possible, okay? Another takeaway is the average length of time of the bear market with and without a recession. The average length of time of the bear market without a recession is 12 months. and with a recession is 16 months. So what that means is be patient, right? We've only just started this rough period, and we might be in it for a while. So we need you to be patient. Those are the key takeaways from that slide. Where do we as advisors get our confidence from? And that is the long-term story, right? This particular section I just chose randomly, 1940 to 1970, includes World War II, includes the post-World War II shock, when they suddenly stopped, when they fired 2 million people from manufacturing in the United States, and a few other crises along the way. You can see these drawdowns were pretty deep at various periods of time, but the trend is very clear, okay? Taking a more recent view from 1990 to date in the S&P 500, I'm sorry if it doesn't come through so clear. The top line is the S&P 500, including dividends, right? Reinvested dividends, and it's a very significant positive. Even with the drawdown at the end here, you're still making money over the long term with stocks. We believe this is going to continue, right? Even with a little bit of a setback in 2022. So that's our confidence on the stock market. Right, recession. Recession is difficult to define. There are various definitions used by different bodies. It's somewhat political. Interestingly enough, the word recession was only started in the 1970s. Apparently, prior to that, they used the word depression. And then when they started talking about a depression in the 1970s, apparently it was the White House who said, please use another word. And they started with the word recession, which is a milder depression. There's a lot of criteria. It's not just simply negative, 2 quarters of negative economic growth. There are other criteria as well. And it takes a while for this data to come out, right? It takes a while. So by the time we formally say we're in a recession, not in a recession, we may actually find that we're more than half the way through it, okay? And very, very importantly, markets are forward-looking. So the bottom of the market will happen before the end of the recession. And that's why we want to stay invested. I can't emphasize that enough. Markets are extremely difficult to be timed. And as I said, more pain is possible. Question we often get asked, if there's going to be a recession, what do I do? Do I sell or do I wait? When equities have already suffered a significant drawdown before the onset of recession, as in the case of 2022, we had the major losses in Q1 and Q2, right? Those were definitely no recession in Q1 and Q2. We may be in a recession now in the United States, a mild one, and certainly not a bad one. And if we've already had the sell-off and now the recession is coming, history tells us it's a hell of a lot better to wait it out and enjoy that rebound. That the 6 to 24 months after you hit the bottom, you really want to be in the market. There was a slide that we presented in the past, which shows how few days are required to materially, how few positive days it takes to materially affect your long-term outcomes. And it's some crazy number that if you miss the best 10 days of the market, just those best 10 days over a longer period, you're going to have a significant different result from someone who stayed in the market the whole time. So it's very difficult to catch those months. Just look at July, right? July was a really, really strong month. NASDAQ over 10%. Anyone who panicked and sold at the end of June because the market was too scary missed out on a very substantial bounce back. Okay, bonds. So we got some questions in the registration process about bonds. As I said, long-term rates have risen more than it was expected. The number we refer to is the US 10-year bond rate. It started the year at about 1.5. It went up to 3.5, and now it's at 2.5. So that 2 full percentage point growth from 1.5 to 3.5, that is ginormous. It was much more than everyone expected, and truly painful to the bond market. And that led to the worst start to the year ever. All right, as I said, we have to operate within the mandate. How did we manage this? We shortened duration as much as possible, what we thought was possible. We could have gone more in retrospect, but at the time we thought that that was enough. And inflation is really difficult for bond market investing, okay? Because you've got a fixed coupon. The bonds are fixed income, and if inflations are running high, then your purchasing power is not going to keep up with inflation. We're seeing now some decent single name bonds producing returns which we haven't seen for a long while. So for example, an investment grade bond a year ago, we would have struggled to find 1.5%. And now that same bond is giving us about 4.5%. So we can get decent single name. I would not go too long in case this inflation scenario does go pear-shaped. I would keep the bonds relatively short and try to protect capital, the purchasing power. You won't grow your money using bonds, but you might keep up with inflation. Not necessarily. So that's why we say equities and alternatives are preferred to straight bonds, but they have their advantages. Just a comment about the local market. The shekel inflation is definitely on the up. For many years, we had shekel inflation of about 1%. We're currently at about 5% shekel inflation. We think that throughout the summer, there's going to be a big part of inflation is rental, property rental. And as many of you know, property prices in Israel have shot up. And we think that the landlords are going to be demanding much higher rents, and this is going to filter through. In addition, a lot of rental contracts are up for renewal over the summer. So we think that that'll come through in August and September. We're going to have higher inflation in shekels. And as a result, the Bank of Israel is going to increase interest rates. So we may see the pain that we had on dollar bonds at the beginning of the year. We may see that at the end of the year. We've reduced duration as much as possible in our portfolios. We've got single name bonds where you can, even if you have a duration impact on those single names, you can lock in your yield to maturity. So we've done what we can in those shekel portfolios, but for sure, I think that shekel inflation is on the increase. And one of the questions we received in registration was about somebody took the time to research the money supply and how money supply in Israel has increased over the last year and a half. And he speculated in the question that inflation might be 10% in Israel and not 5% is what they're saying. I don't think so. My comeback to you is go back to those money supply statistics and take a 10-year view, and you'll get some comfort that there's not a one-to-one correlation between money supply and inflation. But certainly it's on the up. I think that I think we'll get to about 7% in Israel and not 10. Still painful and will still require an adjustment. How this affects, how these rising interest rates is going to affect the property market, that's something to debate. But certainly there's going to be an impact somewhere. Within our shekel strategies, we prefer some of the less liquid bonds with a hold to maturity view. With inside stocks, we've bought financials, which work nicely in the shekel portfolio this year, unlike a dollar portfolio where we bought financials and it didn't work so well. And we're keeping our USA allocations hedged back to shekels. The cost of hedging became very expensive for a brief period of time because the cost of hedging is basically the difference in interest rate between dollars and shekels. And that opened up quite significantly. It's closing now because shekel interest rates are going up, but we still think it's worth holding hedged positions rather than unhedged positions in our shekel portfolios. Okay, inflation. And for me, this is what it's all about. This is the big deal. Interestingly, half of the US population have never experienced serious inflation. We haven't had it since the 1970s. The Federal Reserve's stated goal and reason to exist is to create price stability and control inflation. So I don't want to fight the Fed. Their job is to control inflation. They have said categorically that their long-term goal is 2%, and they believe that they can achieve that number. I'm not so sure. My research and following a whole bunch of economists, they seem to think that inflation is going to be permanently higher than 2%. The Fed will try bring it down to 2%, but they will not completely succeed because inflation is so complex. It's not just about the American consumer. It's about Ukraine. It's about supply side issues, etc., etc. Goldman Sachs predict that the inflation, the core inflation, now there's two types of major inflation. One is headline, which is what the newspapers quote, but core inflation takes away food and energy, and that's the one that the Fed looks at. Goldman Sachs say that the core inflation is going to be 5% at the end of the year, which is lower than it is today, but not low enough for the Fed. And if core inflation at the end of the year is still 5%, I think that's a problem, because that means the Federal Reserve are going to have to increase interest rates aggressively to try to bring that number down, and that could bring about a more severe recession. So that is kind of my fear. The Fed uses fancy word. They say they're at neutral, right? Neutral means that they believe the interest rates are at a level which would neither speed up or slow down economic growth. I'm not sure the significance of that, but if inflation remains high, then they're going to have to increase interest rates to slow down the economy, and that is, I believe, that is not fully priced in to the stock market. So inflation will come down, but not all the way to 2%, as they say, and how they respond to that is the big unknown question. Long-term effects of inflation, I don't think I have to explain this to you. This graph is 60 years, and $400 60 years ago is only $33 today. I grew up in South Africa. I love the Kruger Park. I follow some of the stuff on social media. To go into the Kruger Park in 1970 cost R1.50. And to get into the Kruger Park today costs about 320 Rand to enter. That's a compounded inflation rate of 11% over 50 years. 50 years, 11%, you go from 1.5 to 320. Very, very powerful destruction of wealth. What does this mean for us? You have to be invested, okay? I know we're going through a transition. I know the markets are particularly scary, but you have to be invested because you want your, especially equities, will have a built-in protection against inflation, right? Companies can pass on higher prices to consumers, and the companies can adapt quicker to inflation. As I said, I grew up in South Africa. Ask any South African, they've never owned bonds in rands. They're only 100% invested in equities. Over the long term, there's a strong correlation between the Johannesburg Stock Exchange and the inflation. So there is some element, but the transition might be painful. China, I've spoken about China on all our previous webinars, and it's been a difficult ride. What I want to show you here, the graphic on the left is the relative size of China's markets compared to the United States, 19.9 trillion versus 25 trillion. From my point of view, you cannot have a global portfolio that doesn't have a China allocation because of the sheer size. China is a very different place. They have a different mentality, and the communist philosophy is still very strong. But I believe it belongs in the portfolio. We don't hold a lot of China, but I believe it belongs in the portfolio. It's cost us performance this year, no doubt. The numbers on the right-hand side here is interesting. If you look at, so there was a time when we used to say, when America sneezes, the rest of the world catches a cold. What did that mean? And when America was somehow weak, the whole world was weak, and all the stock markets of the world had some positive correlation. Now with what we're seeing now with China is it's decoupled a little bit. And over the last few months, when the US had a terrible time, okay, so these numbers here are from the end of April to the end of July. The S&P was down -6% about, and these are the various Chinese indices. They were all positive. So that kind of gives me some comfort that China is adding some risk management, funny enough. It's decorrelated, it's negatively correlated to America, and it's very different. And I think different belongs in a portfolio. All right, so that's China. We've some of the questions we got on registration. As I said, I couldn't deal with all of them. The first question is about Pioneer's strategy and these various economic scenarios, because they're very different probabilities, very different outcomes. So the person who wrote this question talked about a soft landing or mild recession or a deep recession and stagflation. As I said, asset allocation should protect us from all these things. What does asset allocation mean? It means allocating money to different asset classes which are going to behave differently. If you point the whole portfolio towards one scenario, if you get that wrong, and it's very hard to get it right, then your damage might be bigger. So we've got some conservative assets, some growth-oriented assets, a lot of US assets, which is the strongest economy in the world. We've got other assets from other geographies, different sectors, and by covering as much as possible, this is how we manage these various economic scenarios. Of course, there's also the alternative investments, which are not part of a traditional portfolio because they're illiquid and not all investors can buy them, and some of them have higher minimums. And these things belong in a portfolio. So having alternatives, in addition to a diversified asset allocation portfolio, having them together can help protect the portfolio almost under any economic scenario. Think back on those long-term graphs I showed you. We've been through it all, you know, from 1940, we've been through crises, we've been through periods of poor economic growth. We've even been through stagflation for a limited time. We haven't really had a severe stagflation, but we've had lots of different economic scenarios, and we're okay today, right? So the transition is difficult. We've allocated assets to to as many different asset classes as we can, and where we think will cover the various scenarios. So that's how we think we can do it. The next question I get asked a hell of a lot is, since the property market in Israel is booming, should we rather increase the share of our portfolio to properties, right? Debatable point, okay? There's pros and cons to property. I always say that it's not about capital markets, where Pioneer traditionally invests, or equities. It's a question of both. You want both investment property, your primary residence, and you want capital markets. The percentages of which you can discuss with your financial advisor, and we can, you can debate what percentage of your wealth should be in property. But it's not a question of capital markets or property, it's both, if you've got enough money. About the property market, specifically in Israel, the typical rental yield that a property investor looks for in Israel is quite low. It's about 2.5%. Now, in a bond portfolio a year ago, when we were struggling to get to 2.5%, you could say, okay, property is more attractive from an income point of view. But now it's the opposite. Bond yields have come up, interest rates are rising, so new money now can achieve more from an income point of view than I believe rental can on property. So that's purely on an income point of view. Your expectations of capital gains going forward, this is very much dependent on where your property is. Property in Tel Aviv is very different to property in the periphery or Beersheba. Beachfront property is very different. So it's very, very specific on what you can expect in terms of capital gains. But one has to recognize that there's a ton of building going on, all right? And higher interest rates mean higher mortgage rates. There has to be an effect on demand, okay? Yes, there's a shortage of properties, a big shortage, and but higher interest rates should definitely take some of that spin out. So bottom line, it's not a question of property or capital markets, it's both. On an income basis, a bond portfolio in shekels today, particularly if you wait a few months for some rate stability and then invest in a liquid portfolio, I think you can do better in bonds than you can in property from a pure rental yield point of view. Next question. So the person asked, should he put money on deposit at 3%? I assume 3% is dollars. I've actually seen a lot higher than 3%. Some of the bank dollar fixed deposit rates are now over 4%. Another person asked about 6.5% in rands. From my point of view, you'd have to pay me a lot more than 6.5% to be invested in rands. So rands is definitely not an option for me. But 4% dollars is an option. Shekel deposit rates are nowhere near that yet. They're still between 1 and 2, and they're rising. So in the future, you'll get more for your cash shekels than you will currently. And whether you want to invest or keep it in cash, that very much is a personal discussion about your appetite for risk. Next question we got was, how do commodities affect our investment decision? We don't really invest in commodities. The only commodities we would consider investing in are ones that we can buy easily, the physical commodity, and that's gold and silver. We don't currently have gold or silver in our portfolios. Too volatile, too difficult to predict from our point of view. The other commodities, all the agriculturals and some of the other stuff, other energies and metals, when you buy commodities, you're buying futures contracts, even if you buy an ETF, and sometimes you don't get the outcome that you want purely because of those futures contracts. Okay, so buying commodities is not so simple. This year, if you were in commodity companies, it was a good place to be. Commodity companies did exceptionally well from January to June, but in June that reversed quite aggressively, and they gave back a lot of their gains. Obviously, the energy companies like the Shells and the Chevron and all of that would have been a good place to be this year. Okay, structured notes. I'm a big fan of structured notes. I like structured notes, but the environment has changed. So in the past, we would buy structured notes to try to change out, to try to replicate bond-like yields without taking on too much equity-like risk. Now that we're getting better yields in bonds, we don't need those type of structured notes. So the type of structured notes has changed. I don't want to get into it. It's quite technical, but I like structured notes. They are available. We have done less this year than we have in prior years, but we will continue to invest in them. Israeli inflation, this is the point I dealt with earlier. And lastly, someone asked about converting dollars to shekels now, okay? This is a very personal thing, and one needs to look at your holistic wealth and what percentage of your wealth is in shekels, what percentage of your wealth is in dollars, and take a view from that point of view. I do believe the shekel, when we get some market stability, it might not be this year, but it might be next year or the following year, where as soon as we have market stability, I believe the shekel will strengthen again. So right now the shekel's at 337. It was in the 340s. That would have been a good time to convert dollars to shekels. Even if you had a loss on your dollar portfolio year to date, and you sold it and converted to shekels, you're significantly reducing your loss. If you had the benefit of a time machine and you go back to December, you could have sold your dollar investments at 3.1, invested in shekels, your losses would have been less in shekels than they were in dollars. But you'd have a shekel portfolio. Now, your dollars that you've held through those 6 months, if you convert them to shekels, you can at least have a much lower loss. But it's got to be driven by your personal circumstances and your personal needs. If you don't need shekels, then it's a different question. If you're living in Israel or plan to live in Israel and you need shekels, then I would definitely support using the higher rate to convert some money to shekels. Okay, some concluding comments. All investors, especially conservative investors who are bond orientated, had a major blow to their long-term goals into June, right? We recognize that, we understand that. It was painful. This is part of investing. Investing don't go up. We try very, very hard to match expectations of clients. I think we've done a reasonably good job of that. You should review your financial plan, have a chat with your advisor, and make sure that your plan is still relevant. I don't throw away your long-term assumptions just because of one bad year. I try to get that point across in this webinar that it's not just about 1 year, it's about long-term investing. Place priority over risk tolerance rather than the return demands. I don't like clients not sleeping at night because that means I don't sleep at night. So if you've got too much risk in your portfolio, then you may want to consider reducing that risk, even though selling now is going to be a little bit painful. We still like the USA. We've still got a big bias towards it. And again, we favor equities and alternatives over bonds on condition you have the stomach for the volatility. Keep bond duration short. Be patient with China. For Israel-based investors, definitely use the weaker shekel to bring some more assets in. In general, as a general rule, most immigrants, most English speakers on this call from Israel are underinvested in shekels. That's a pretty, I can say with confidence. So yeah, maybe use that weaker rate to convert some money and keep your eye on inflation. This is, for me, the big issue is inflation. Ukraine is less of an issue now. Obviously, it can blow up and become more significant. There are lots of other risks in the world, but right now it's all about inflation and what the Fed response to that inflation is going to be. That's what it's all about, and that's what we try to protect against. Okay, so let me just see if there's any new questions. Property in ENG in Israel, 2%, 2.5% for that's residential. Commercial is higher. Commercial, but it's a much more risky story, commercial property, because when you have a vacancy in commercial, it tends to be a lot longer than a vacancy in residential. Hope I answered that question. All right, it looks like I've answered all the questions. Thank you for the time. I hope you found it worthwhile. And if there are any follow-on questions, please email us. This will be recorded and is available on our YouTube channel, and just look out for it if you miss something, you want to catch it again. Thank you all. Wait, I see another question. You indicated the need to convert from US dollars. What about sterling to? Well, the sterling rate hasn't moved as much as the sterling shekel hasn't moved as much as the dollar shekel. So it's not as obvious. It's not as obvious an opportunity. So at the beginning of the year, I think from the top of my head, it was about 4.2. It went up to about 4.3, and now it's 4.15, or I don't know, offhand, but it's not an obvious opportunity like with dollars. So it's a bit more nuanced, a bit more. What's your personal circumstances? What are your assets in shekels today? What are your, what are your specific needs? And you may have to, from a financial point of view, it might be the right decision to sell sterling and buy shekel, even if the rate is not favorable, right? It's just not as obvious from sterling that it is from dollars. I hope that answers the question. Okay. Oh, some more questions. Okay. Do I know if USA estate duty applies to non-Americans? Absolutely, it does. Its formal name is non-resident alien estate tax. You can Google that and read the Wikipedia page about it. It is the most draconian tax in the world by far. It applies to US citus assets. So if you are a non-American living in Israel and you own Apple, technically that is exposed to US estate tax above $60,000, which is a very low minimum for such a heavy tax. There are ways around it, and we like to buy Dublin registered ETFs. So if we're going to buy the S&P 500, we'll buy the Dublin version and not the US version. So that's not a US citus asset. It's the same underlying exposure, but we've avoided the estate tax. So absolutely watch out for that one. It would make whatever returns you've made in your life, if you get caught out by that American estate tax, it's a big deal. With the recent decline, is the right time to invest? I would definitely start. We never, with a new client at Pioneer, we never jump the whole portfolio into the market in one piece. Depending on the risk profile, typically you buy conservative assets faster, risky assets slower, and you start to build the portfolio based on a predefined period. I think you can start buying, you can see, or you can just get everything ready, the paperwork and whatever. And if we have that next leg down because of rising interest rates and Federal Reserve policy, if that happens, then you can move quicker. So I'd get everything ready and paperwork, etc., and then consider jumping in at the right time. And that's all. Okay, good. We are 53 minutes, so a little bit over on time. I apologize for that. I hope you've enjoyed this, and we shall be in touch. Thank you very much.